Do you think volatility is going to be something that's with us for a while as a result of, well, in your view, the market underestimating how tough the Fed is going to have to be with rate hikes around inflation? Is that going to continue to create volatility?
Well, there is going to continue to be volatility because, 3 data points in a row are a new trend line. And we've got lots of noisy data like CPI, core, and headline. We've got the jobs data. So everybody's really trading on all these different data points. So we expect a lot of volatility ahead in equity markets as everybody tries to answer the major question, which is how much of this inflation is due to supply chains and how much is simply all inflation is at the end of the day a function of monetary policy and too much money sloshing around in the system.
How do you measure that? I mean, I'm looking at the VIX here. If I just pull up a 5-year chart of the VIX, it doesn't look that volatile to me. Is there a better way to measure volatility, Mark? Because obviously we all see these prices going haywire. One day it's gas prices are rising the most that they ever have, and the next day they're slumping like 20%. So how do you measure volatility?
Well, that's a good question, right? In the sense that I think there is a very acute volatility, VIX, where people rush in to buy protection, and we get these. We've got a history of the Federal Reserve and other central banks effectively suppressing volatility until we get a major spike in VIX around some crisis or something. And I think it's right that it's a little bit different what we're saying going forward, which is with the Fed taking these actions, we're going to have a little bit more maybe day-to-day volatility, and then also periods where the market moves up and down as we start to formulate these trends around is the data getting worse on inflation or better. So I do think that with the central banks now hiking, kind of the way we think about volatility may change.